This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this chapter, we're going to look at tax-adjusted trading profits for individuals. These are trade profits from somebody who is self-employed. But before we get into the meat of that, I just want to talk about one topic called the badges of trade, which you could get asked a multiple choice question. You could get asked a small proportion in a section B or a section C, but it's a very important part of tax legislation that you need to be aware of. So these badges of trade have been brought in over the years, mostly through the legal system, where individuals have worried about whether or not something is being taxed either as income or as gains. This is the situation we find ourselves in. So let's look at the rules first, and then I'll explain a little bit more about why we need these badges. So there is what's known as a mnemonic. In other words, S-O-F-I-R-M. So firm. S-O-F-I-R-M. That's the way to learn how to remember what these different badges are. So we'll go through the badges first, and then I'll explain to you why we need them. So, subject matter. Is a person trading or not? You need to look at what is actually happening, what it is that is being traded. So what is the subject matter? So is it a house? Is it a piece of land? Is it a piece of art? Is it something you've made? You need to look at that. How long have you owned the asset that you are selling? So it says there, where items purchased are sold soon afterwards, transactions are likely to be treated as trade. You wouldn't hold on to your stock. You would get rid of it as quickly as possible. If acquired unintentionally, i.e. you inherit it, and then sold, it's unlikely to be trading. Never use the word it is in this. It's a possibly, probably. And I'll explain later, but you need to know them. So S, subject matter. O, ownership. F, frequency. The transactions are a capital nature, okay, will be interpreted as trading transactions where their frequency indicates carrying on a trade. In other words, you're doing it repeatedly. If it's a capital item, like a house or a building, you wouldn't be doing it repeatedly. It'd be a one-off, which means it's more likely to be dealt with as capital. If you're doing it regularly, it's more likely to be trading. I, have you done some improvement? It calls it supplementary work or marketing. So when work is done to make an item more marketable, or you're attempting to find purchasers, it's more likely to be a trade. That's obvious common sense. And you do have to put some common sense into this once you've learned S-O-F-I-R-M. R, the reason for sale. Was it being forced to raise cash, or are you doing it to make profit? And again, that works with this one. What is your motive? Now, why? Why do we need these? Okay, so if an item is treated as trade, then you have income less expenses, and there are lots of them that you can claim in your trade, and that would equal your profit, which is then taxed at either 20 or 40 or even 45%, and you would pay class 2 and class 4 NIC, and it's classed as pensionable income. If you determine that something is not trade and it's taxed under the capital gains tax rules, then that is the proceeds that you received, different terminology, less the cost of what you bought it for, equals what's known as a gain rather than a profit. Now that's taxed at anything between 10, 20, 18 or even 28%. You notice the rates are lower. There's no NIC and it doesn't count towards your pension. So over time, what's happened, we've had clients that have perhaps come to us where they have maybe a job, and then they've started to sell things, and you have to determine whether they're selling something is a trade or whether it's a capital gain. Is it a one-off? Did you inherit it? All of these rules have to be brought into being, because over time, perhaps you have said to your client, oh, that's definitely under capital gains tax rules. You sent it off to the revenue using proceeds less cost equals gain, taxed it at the whatever rate is applicable. And the revenue have looked at it and decided, maybe not. I think this is, and they will look at all of these rules and they will determine maybe that it's actually trade. So they will query the tax return and say, no, we don't agree with that. They'll do a bit of an investigation into the client's affairs, look at what's going on, and they will raise an assessment to say that actually it's trade and we want tax at 40%. You tell your client this is what's going on. The client wants to fight it. So you've now got an argument between the revenue saying it's trade, we want 40%. You are saying that it is gains and you're only going to pay tax at 10 or 18%, whatever, and it will go backwards and forwards. Now this has happened so many times in the past that there have actually been legal cases and laws brought into place to determine whether it's one or the other. And these SOFIRM, these 6 badges have been brought into play so that you have more guidance when you are dealing with your clients. So you need to look at those 6, remember what they are, remember the rules. It's not black and white. If you come across one of these in a question, it's possibly, probably, would have to be discussed. It's never black and white. You will never have to determine one or the other and then work out the tax as a consequence. The kind of question at this level, TX, would be, what are the badges of trade rules? How does this apply or imply, implications in a scenario? That would be the sort of thing that they would be asking you to deal with. You would never have to determine one or the other. They want to know, do you know the rules? Can you apply the rules, the specific rules, to this question? Read the question carefully. Okay, so that's just something that you need to be aware of. Now, we're going to adjust accounting profit. So, the tax adjusted trade profits for inclusion within the income tax computation is not the same as a statement of profit or loss. Let me just explain to you what I mean by that. I'm just going to find a piece of... So the adjusting of this profit needs to then go into the income tax computation, but it can't go into the income tax computation until we've made the adjustments as I've explained. The net profit per accounts from the accounts before tax is where we start. We're then going to disallow certain non-allowable expenses. Okay, and we're going to add those back. And then we're going to exclude or remove any non-trade income. As I said, rental income, business, bank interest, those things are taxable but not here. So this pro forma that we're going to look at, you need another pro forma. This is The same pro forma for individuals, for partnerships, and for limited companies, with just a few tweaks. It is a large pro forma, and it usually, not always, but usually forms either a 10 mark or a 15 mark question in the exam. It is highly examinable, so please learn the pro forma. This is a very, very important chapter. We start with the net profit per accounts. When we go through the examples, you'll see where that is. Sometimes in the requirements, they actually tell you where to start and then give you some very specific instructions which you must read carefully. We're then going to add back all the expenses that is not allowed for tax purposes. We're going to add those back. Now, there is a big list of those, but there are some principles that we need to put into place so you don't have to learn the list. And as you practice the questions and we go through them, there are certain things that come up every time. And what the examiner also does is he will give you two alternatives. So one of them will be added back and one of them won't be. So you sometimes have to pick. If you have to make an assumption at any time in one of these exam questions with your answer, please put in, I have assumed. And as we go through the examples, you'll see that this comes up sometimes, not very often, but sometimes. We will then take out items which are not trade profits, i.e. income that's assessed elsewhere. As we've covered before, property income, normally bank interest, those sort of things, or any other exempt income. That will give us adjusted profits, and then we will take out capital allowances, which is a separate chapter, which we will cover at a different time. You need to have read the capital allowances chapter in together with this one, because the two of them are very closely linked. And that will give us our answer, which is a tax adjusted trade profits. Okay, so it says, when preparing this calculation, be careful to start with the net profit per accounts and read the question carefully.